Good morning or good afternoon, depending on what side of the country you're on. Thank you for joining us for our webinar today. Really excited to spend a little bit of time with you. Sorry it's a little dark here today. We've been having some camera modification troubles, but we're getting through it. But with that, I want to thank you again all for being here. We're doing our industry planning, budgeting for 2022 webinar. Really excited today to have in person a number of people with me here. Really exciting, but I have Craig Cecilia, our Chief Investment Officer. Craig, thank you for joining us.
Welcome.
Also have two great people from either side of the country. Chris Mueller here next to me from our Albany, New York office.
Hi, thank you.
And then Bill Barrett here, who came in all the way from our California office.
Thank you. Welcome.
Yeah, so thank you all for coming here. Really excited for today's webinar. We're going to cover a lot of things, but there is going to be a question and answer opportunity. If you scroll up or down on your screen, you'll get the little pop-up for Q&A. Please feel free to type your question in there. We'll answer it along the way or at the end, whatever is appropriate. Also, this webinar is being recorded and will be available on our YouTube channel, so please reach out to your advisor to get a copy of it if you'd like after the presentation. So today, it's definitely an interesting world that we're in, and trying to plan for 2022 is not the easiest thing. So what we wanted to do is provide an interactive discussion on what we see coming up for 2022, along with some solid data points to ensure that we're giving you good advice for 2022 and what lies ahead. So we're really excited to talk about things. Here you can see we're going to go through an interest rate prediction. We're going to talk about expenses in the pandemic, deposits, loans, investments, non-interest income, and then a little bit of a Q&A discussion. So again, thank you for joining us. We're going to kick off the presentation now. All right, so our first section is interest rate predictions. And we kick this off. The first question is for you, Craig. Interest rates have remained low for the past 2 years, as you have predicted correctly. Where do you see interest rates going in 2022? And we've put up a copy of the yield curve behind you to start the conversation.
Nice. Thank you, Charlie. We have been in a pretty relatively mundane, flat, boring rate environment. I always like to say we've been in a very steep yield curve, right?
This is different. This is backwards.
Exactly. So I love actually the chart here, if everybody can see it. Today's interest rate curve versus a year to end of 2012. And what's so relevant about this is that a year later, we started talking about tapering. When we were going through that last taper cycle, it started at the end of 2013 and lasted into October of 2014. And of course, we all know what happened. We had to reverse our heels and retreat, as they say. So we're kind of entering that stage right now, whether we need to be tapering or not. That's a big conversation taking place. We do see impacts of this conversation and the Fed's deliberate change in words in their last meeting. So, and rates have been rising. We do expect rates to rise a little bit more, but not materially. We're not calling for a rate hike. We're calling for a little bit of increase in the interest rate environment and a little bit of steepening. But right now, we've actually seen the spread between 2s and 10s come up to about 120 basis points. I hadn't checked it before our meeting, but by the end of 2022, maybe being even up to 175 basis points by the end of 22.
It's a pretty good chunk up, a little bit of movement rates, not a ton. And you're looking at rates. We have this other graph that those of you know me love. I love this chart. Looking at the Fed funds rate in red, the 2-year Treasury in blue, and the 10-year Treasury in black. And this actually goes back for 20 years, from 2001 effectively to today. It's a really neat chart.
Yeah, I love it as well. It kind of looks at our economic expansions, our recessions, and on the right side of that chart, you can see where we are today. The 10-year Treasury was starting to break out. We're seeing that expansion between the 2s and 10s, steepening of that yield curve. Great for everybody on this call, right? To make a little better margins where balance sheets are lined up. And we're expecting it to see it to widen a little bit more as we go forward because of the increase in interest rates, but not the increase of the overnight borrowing rates at the moment.
Yeah, so one of the things to think about here is a steeper yield curve makes more money for us. And we actually have a very steep yield curve. We argue about this, as you probably all know, and listening to us here. We always argue about this, but it is a steep yield curve. And we're going to talk about some of the benefits of being fully invested. And how we have some clients actually doing quite well because they're taking advantage of the steep yield curve versus waiting for what may happen. And what a lot of people are waiting for here is the Fed. And Craig, as a follow-up, the FOMC keeps talking about tapering tantrum, I think is what you call it. When do you see them actually tapering, and when are we going to see a Fed funds rate change?
Oh, I love it. Thank you for using that analogy, by the way, because my kids are older now and I don't get to see tantrums anymore. So.
I saw one Saturday.
Absolutely. Well, you can see on the bottom of this chart, as you guys look at it, right now, the futures market is not necessarily indicating a raise in overnight lending rates in the next 12 months. But the tapering question is extremely important because before, in my opinion, before we have any kind of movement on overnight lending rates, i.e. the Fed funds rate or the discount window rate, is we need to see tapering take place. And that obviously is what everybody has in their minds. We expected it this past month of them to announce that they're going to have some tapering. And he did change his language about what they were expecting. And maybe in November, we're going to see some language about here's our plan. So do we expect tapering? Yes. It probably will take place in the next probably 3 quarters of a start. Last tapering exercise that they went through took about 3 quarters to go through, 10 months. We'll probably expect the same thing this time as well.
Okay, so what you're saying is we won't see Fed funds changing until tapering's done.
Correct.
And
That is
that's
right.
probably a good 3 quarters away if it starts soon, maybe 4 quarters away.
Absolutely.
Okay. We did have a question pop up. Someone asked, this little blurring in the slides, and we're trying a new format here, so I apologize, little technical problems. We will send a copy out of this, so please reach out to your advisor. We can give you a copy of all the slides that are here today. Well, speaking of new things and technical problems, we could call this graph of inflation maybe a technical problem. Could you explain to me what's happening here? We talk about transitory inflation, non-transitory. What can you give me some insight? What's going on?
Absolutely. So inflation's just been interesting, and I can't say that we're redefining anything here. We're not redefining inflation with this economic cycle. And I'll use a quick example as oil. You know, we did now hit oil as being the highest it's been for crude since 2014. That's going to translate into everybody here, and especially on the call as well, or including everybody on the call, to gasoline prices. They're going to escalate. They're going up. You know, and that is kind of like not a core number that's considered a part of inflation, but it's there. It's very relevant. You know, overall, the Fed's been talking about transitory inflation, you know, temporary inflation for a different way of saying it. And temporary inflation is normally caused from a disruption in normal economic activity. And the pandemic's been a great example, as we all know, right? Just really decimated economy around the globe.
Right.
And we've been slowly coming back to where we were pre-pandemic and actually growing further. Regular inflation, let's keep it at a really high level, is where supply is not really meeting the economic and financial and production of an economy, right? And when that supply is not meeting it, that demand, they have to go and add on additional capital expenditures, resources, creating demand that takes a while to ramp up. It creates a longer-term inflationary cycle. Now, the one thing that helps out in inflation, which we're also talking about, is wage inflation. And typically in any kind of inflationary market that's non-transitory, you should have a wage inflation component in there, because inflation really eats away at the real buying power of a consumer, right? When the wages don't keep up with regular inflation. And so wage inflation helps offset that risk of a consumer being less relevant in an economy, because we need that consumer to keep driving things forward. Have we been experiencing inflation? Yes. Is it temporary? We do think it will change over the next 3 quarters as we fix supply chain issues. So we don't think it's necessarily by definition transitory, but it's not long term. And that's why we don't feel that the Fed's going to be raising overnight rates anytime soon.
Yeah, I do see the wage-based inflation causing some potential problems over time, but I think we need to be cautious about wage-based inflation, understand it's going to affect things, but might not be the end all for big long-term inflation.
Yeah, well said. You know, and the other component we have is the whole participation rate. That's not necessarily being considered all that much when people are talking about why wage inflation is here. There's a lot of people not being active in the job market right now. There's a big spread there, and we still need to get people back to work.
Okay. But with that, we do have a request. Everyone could speak up a little bit. Really appreciate that while we talk. And but what we have here is our predictions of interest rates, and probably not the easiest to see on the screen, but maybe Craig talk a little bit about our predictions here, which won't show rates going far.
Yep, no, yeah, so everybody says, hey, are you predicting to go up or down? And that's the question. We got to really define what we mean by rates going up or down. For the Fed and them controlling interest rates, or at least using interest rates to manipulate or govern in economic expansion, we do not expect that. So overnight lending rates, Fed funds, unchanged. We do see the curve going up in general with a slight steepening. So you can see if you everybody loves to talk about the 10-year, that 1.5 rate right now, going up to about a 235 by the end of next year. Whether it gets there, it's still not a material change. It kind of gets us to where we were prior to rates pre-pandemic levels, actually, where we were before, which is a good number.
Okay, so now there will be sending this out with our quarterly economic update, but it does show no change to the Fed funds rate until December of 22, going from 25 to 50 basis points. So definitely a long time with low interest rates as we predicted for the last couple of years.
Right. And the last thing to talk about is just like our expectations on inflation and GDP. And I like that GDP conversation. Really good, strong GDP at a declining base as we go forward. And as we fix supply chain issues, having a pop back up a little bit near the end of 2022. That's what our hope is.
Okay, wonderful. Thank you. I appreciate that.
Yeah.
So Bill, with this economic prediction, how do you see things affecting the asset liability management reporting and the asset liability management position of credit unions and banks?
I think 2022 is going to be similar to 2021 here, where we're going to be in a low rate environment, as Craig says, for the short-term rates and gradually increase on the longer end. So we're going to be in that environment for most of the year. And then it's also, creating tight margins for us. So we're going to still be under margin pressure. And one thing I mentioned, and I think Chris may talk a little bit about this to an extent, is we still have higher yielding assets that are rolling off and maturing into these lower yield environment. So it's going to be a challenge to reinvest that money and get additional yields. But it's definitely better than going into cash. So one thing I like to emphasize is that, sitting in cash is not going to be the best option going forward. Start putting that money to work. We'd love to do it in loans if we can, and if we can't, let's put it to work in investments, and then structure you guys some ladders that, as it matures, you can start reinvesting it. Because as Craig says, if rates start moving up throughout the year, you'll be able to reinvest in higher rates.
It is going to be interesting, Bill. I definitely think it's going to continue to have some tight margins because of this prediction. And although it is a steep yield curve, so we should see potential for better earnings for those that are deployed into the yield curve correctly. Well, Chris, how does this affect the investments for the clients you're managing investment portfolios for?
Yeah, as Bill said, we're expecting more of the same for a while. Hopefully we'll see a slight upward trend in 2022. But a big concern that we have is the coupons coming off the books. Remember, if you're a 5-year investor, 2017, 2018 was a peak in rates. I have a client, we're losing a 2.95 coupon this week, and it's painful. Your cash almost has to work twice as hard for you now. And it's really important to maybe take a look at your policy, take a look at your portfolio. What can I do different? Can we change our policy limits? Can we look into new asset classes? That's really important. Now is really the time to look at that because we're losing those good investments from a few years ago. Expanding yourself into things like our alternative portfolios, which we'll talk about a little bit. Now is the time really to think about those changes for 2022.
Yeah, it is. It's a great time to think about changes and plan for this and not wait for what you think may come. So wonderful. Well, thank you. I appreciate the update on interest rates. Kaylee, here, something. If we go to the next section here, it's expenses in a pandemic and pandemic expenses. And, this is an interesting one. And one of the things that we're seeing is we're seeing some financial institutions modify their branching numbers. We're beginning to see people maybe cut some expenses. Hopefully that helps out a little bit here. We're seeing some people do some different things. And, it's interesting to me. I'm wondering here, we've seen people decide to cut branching hours. Are you guys seeing people close branches, just general for the group here? Are you seeing our clients close branches or open branches?
I'm actually seeing a few with the staffing issues right now, send out like a daily alert saying such and such branch is drive-through only today due to staffing. So I think that's gonna cause people to really reevaluate branches.
Right, and I echo that as well. They're shortening the in-lobby hours and they're using some modern, and we talk about technology of replacing some of that as well. And it's being very well received by consumers.
Yeah, our clients are also experiencing staffing issues. You know, it's been hard to hire staff, both at the line level and throughout the management team. So it's one thing that they're experiencing, like the rest of the industries are, is a lack of employees to come on board. So one of the things we want to talk about to an extent also is some programs that we have with the EBPA to help offset some of those costs, and also benefit costs are going up. You know, as we know with COVID, insurance premiums are going up. So, you know, we do have a program that we can use to help offset.
Yeah, so there's a lot of different things to help, but I think there are some options with branching and facilities to think about, where we're seeing people use branches as operation centers, call centers spread out to branches instead of building a new facility. We're seeing people do a lot of different things to really try to make the best of what they have. And on top of that, we're seeing people do different hours. It's really interesting, different hours for every branch. So next question, Craig, are you seeing a lot of technology expenses, data security expenses? Should we continue to see this come up, or are they going to drop down fine?
Excellent question. We're talking about expenses and budgeting for next year. And there's some items that have grown from just got lumped into a different technology expense to where it's its own real line item. And cybersecurity is a great example, as we've seen that importance of that, the expenditures on that go over the years. But in addition to that, because that's not anything new, and I don't think you're gonna get a lot of benefit out of that, some other technology expenses that I think is very relevant now is really kind of what we learned from the pandemic. A couple of ideas and a couple of things that really have been slowly being adopted and needs to be adopted by more is the whole video experience for customers, right? We all adopted that for internal meetings with some vendors and with external companies as well, but we need to drill that down and bring it to the consumer. They've really proven that we can survive with limited branch hours or no branch hours for R20. And the expense for bringing on that video capability for consumers is expensive. Another great example is where's the pain point for accounts? It's the account opening process. And a lot of banks and credit unions have adopted the digital opening process. They still need to tweak it, and a lot of organizations who are early adopters, but a lot haven't adopted that either. And those are additional technology expenses that people can expect or should be doing to keep up with the market or keep up the Joneses, if you will.
Yeah, you got to get to people in alternative ways, and you've got to open up online. You got to build service online. I always joke the best branch is my cell phone, and a lot is changing there. So I do agree with the expenses are going to continue to be up. Bill, I have a graph of unemployment here on the screen, and it's really interesting. Bill, what are you seeing when you talk to your clients about talents, people, expenses, and what's happening there today?
As I was mentioning, it's been very difficult to find employees. You know, a lot of folks we're hearing, you know, trying to get tellers in, or different people are telling them, well, I can get more money down at the Amazon. There's an opportunity to offset some of those costs, because those costs are increasing a lot due to the pandemic. And I think, you know, it's going to continue into 2022 with the competition for talent, right? There's a big competition from entry level all the way up to executive level. So it's something to be definitely concerned about and looking at, and even in mergers and acquisitions, you know, to retain talent if you go through a merger or acquisition.
Definitely an interesting spot, and you know, it's with these up costs, the employee benefit pre-funding accounts have been something that we've seen a lot of success with in the credit union space, where people are able to drive additional income, to be able to pay higher wages and sign-on bonuses and all those other things. So really, really important. And acquisition of talent, the promise of talent. So All right, Chris, Bill mentioned he's seen more people, I mentioned he's seen more people using EVP accounts to retain talent. Can you expand on this a little bit from an investment advisor perspective?
Sure, sure. It goes back to that whole idea of your cash working harder for you. As Bill mentioned, a good benefit package is something great to have in your arsenal to get that talent. Healthcare costs continue to go up, inflation or no inflation, they're going to keep rising. So why not use your excess liquidity, segregate it to try to help offset some of these costs? The employee benefit portfolios that we run are separate from your regular investment portfolio because they have that designation of offsetting your employee costs. You can invest a little bit more aggressively. And with that, we're seeing in a range of 4 to 5% yields. That benefit can go towards those costs. It can help offset those costs. It's a special designation of that. Our team here did a fabulous webinar a few weeks ago on that. If you need more information, I highly suggest checking that out on our YouTube channel. We're seeing a lot of interest in that product right now.
Yeah, it really is exciting to see what's happening there. And we're seeing a lot of modifications. So thank you, Chris, for sharing that. Next topic I want to spend a little bit of time on is deposit predictions. And it's interesting. A lot of people think, gee, I don't need deposits right now, so why focus on it? But one of the things I've seen over the years is an institution will focus on sometimes gathering the wrong types of deposits, or we're really going to always focus on CDs. Today's the day to make sure that you have a refined focus on your deposit structure, looking at checking accounts, non-interest bearing deposits, focusing on more and more of those to bring those in, even though you don't need them, but maybe prepare, go through the process and really push. And so with that, I just want to share that background. It's always something to think about. We want to take a step back and think a bit differently about where we want to go and what we're doing with that. Craig, one of the things we've seen here, and I've got a graph of the M2 behind us, and M2 is money supply, and it's a hockey stick top there, I think is the term I'm going to use. We've seen unprecedented levels of government cash given to Americans. Do you expect this to continue, or are they done for a while?
Sure. So yeah, I love this graph because it shows in this recent on the right-hand side where you see the yellow shaded area of the 1 year supply of money is really accounted for several years in the history. I do expect the programs to slowly go away. What we're going to have is a really big impact to our economy. And once again, that's why we don't feel that interest rates are going to go up some. As we see the pullback in some of the money supply that's going in, we need to absorb that as institutions and as consumers. It's going to be impactful to a lot of things. It could even trickle into the equity markets, for example, where money has been going into. When you don't have real rate of returns, which we've been in, where inflation is higher than interest rates, the natural progression of any market is to go into the equity market. That's why if we start pulling that supply down, it's going to impact a lot of areas. We still have a little bit of tail end of the kitty cash that's coming in this year. Next year, it doesn't translate into true cash. It turns into a tax situation with respect to filing taxes and your credits type thing. This year has been a hard cash type thing. But hopefully they're gonna be done, bring back things down to normal, and then we can start functioning under a financial system that we can predict a little bit easier without having the government injecting so much liquidity into it.
So the kitty cash thing is, I think, $18 billion a month right now. Is that the right number?
Somewhere in that range, yeah.
It's amazing. It's
Big number.
No big deal. It's only 18 billion. We're talking about a 1, 3, 5 trillion spending package. Who knows what it is today? So it's interesting. This is one of my favorite graphs, and this is deposit growth in the banking system. And we've gone from 14 trillion to 18.5 trillion in 5 quarters, a 27% increase. Just massive increase in the number of deposits we've seen everywhere. Unprecedented. I mean, we've never seen this before. This is related to all the government programs, money being given direct to individuals, PPP programs, everything combined has just resulted in more and more deposits. Truly amazing to me. Bill, deposits have clearly risen a little bit this last year, last 5 quarters. Do you see this continuing? What do you see?
I like to say that definitely it's been tremendous growth that we haven't seen before. And we don't think it's going to continue at the rate that it's been going because it's been unprecedented. And, historic highs you can see on the graph right there. So I do think the growth is definitely coming down, and maybe I want to say deposits expecting to be stable. We don't see a lot of people going out and expending, at least initially. That spending is going to be withheld a little bit to an extent because we're dealing with Delta variant. People aren't traveling as much as they did before. I think the holidays will be important coming through to see how that comes through. And then, so I'm thinking deposits are probably going to be about flat to a slight reduction going forward.
So flat to a slight reduction. People are going to spend money. Is that what you believe?
I think they're going to spend some, but I think they're going to be hesitant till we find out which way the economy is going to go. Plus employment, there's a lot of jobs out there. So it's going to be interesting to see if the jobs, people start taking the jobs because the jobs are available, but they haven't been taken recently.
Interesting. I hope deposits stabilize or come down. We'll see. I think a lot of it does depend on COVID, and it could be really interesting to see what happens there. And that's part of the hard issue of predicting right now, is knowing if the COVID gets worse or better, and hopefully better. We're all thinking that way. That should make the economy move a little bit. Chris, do you see liquidity changing anytime soon either? I mean, liquidity is different than cash. So do you see liquidity changing anytime soon?
Based on conversations with clients, I regularly ask that. Are you seeing deposits walk out the door? And they're telling me no, or liquidity is still sticking around. In addition, we've had them continue to tell me loans are paying down at a rapid pace. That's coming back at you. A lot of institutions have built a really solid investment ladder. Those maturities are coming back to you. So I do think that liquidity will be around for a while. So again, important to keep that cash working, keep it working for you as best you can. Don't sit around and think that rates are going to go higher, so I have to put my money on hold. We really recommend getting your cash working for you as soon as it comes in.
Yeah, it's one of the things that just using that cash appropriately is really, really important. And, it's interesting, Craig, you mentioned earlier, a very steep yield curve. And it is a steep yield curve, and that gives really positive activity. And that's what you want to keep using that cash, investing that cash, making sure it's doing the right thing. So I appreciate those comments, Chris. All right, well, I'm going to ask my next questions for both Chris and Craig. That's good. Do you see, what do you see that our clients should be doing with cash in 2022 and all this deposits? What should they be doing with that? I mean, the deposits become cash. What do you expect people should be doing this next year?
It's a good question. It's been a question on a lot of people's minds for the last, 12 years, quite frankly.
Yeah.
They've been trying to do it, but lending is the key, right? And we all know that. And try to loan when you can. And we'll talk about some products that have been really working for clients across the country. But lending as much as possible whenever you can. This cycle that we're going to be seeing isn't necessarily going to be a credit cycle. And that's important to think about. If we have a inflationary period, we don't expect a deterioration too much for credit. So lending is good, and do it as much as possible. The other thing is with the liquidity that, Chris, you were talking about, you don't expect it to go away, right? It might decline, might fluctuate a little bit. It's going to be here, is to take the advantage of looking at some other alternative investments. Chris, you mentioned the employee benefit account earlier for offsetting some expenses, higher returns. Bill, you mentioned about mergers, and we see a lot of them coming, and they're using those accounts as tools to retain executives or to help them come on and bring on good teams of people with those. So those are some things to use during this environment to soak up some of that excess liquidity. Chris, do you want to add anything on there?
Yeah, I mean, the past 18 months have felt like such a rush. And I think if you go back and look at what did your portfolio look like at the beginning of 2020, and what does it look like now, there could be some major shifts. Take a look at your duration. Where is that in relation to the rest of the balance sheet? Can you extend out a little bit? Again, everybody's unique, so make sure you can take a look at your risk profile, but maybe you can make some changes to help improve the return of the portfolio and different asset classes, different duration, different investments.
It's interesting, Chris, you mentioned correct duration, and we'll talk later. Our next webinar coming up on November 10th actually is about investment product selection and duration. And I really think it's important today as we see a number of clients with really good earnings and a number of people with tougher earnings. And a lot of times it's the people that are sitting on the sidelines. They're not deploying cash. They're not looking at ways to do other types of earnings. You've got to make some decisions and not sit in cash now, given the shape of the yield curve. It's really important. And I'll never forget this, Craig. Years and years ago, we're working together and the first inverted yield curve showed up. And your comment to me was, you have to buy long. And I said, what do you mean? The 2-year treasury is yielding more than the 10-year. Why would I not buy a 2-year instead of a 10-year? And you told me, you said, look, rates will change.
Rates will change. The interest rate curve is very smart. It's very tale-telling
Yeah.
of what's going to happen in the future to come. And this low rate environment is very tale-telling right now.
It's really interesting to me. I was really surprised by by that. And you look back and get our graph up earlier, the history of interest rates. And it was really quite telling to me how that worked. So, well, so what you guys have told me here for 2022, we need to focus on investing, fully invested, and we're talking a little about products in a minute here, but fully invested and the correct duration. Now, Bill, you're thinking about talking with clients about ALM. Have you seen people's duration shrink or grow here in the last year, their overall balance sheet duration? What's happened with that?
I've kind of seen a mix to an extent. So some of the clients that have been able to generate loans, it's extended out or putting the money to work a little bit, but the ones who've been sitting on the cash and the overnight funds has come down to an extent. But we think people have the ability to take on the duration risk because we need the earnings. So going out, investing and getting out of cash and overnight funds, as Craig says, we first prefer loans if we can get it, but then if we can't, put the money to work and get out of cash.
Chris, you said duration and your head bounced. I noticed it here out of the corner of my eye. What are your feelings on that?
I think a lot of institutions might have limits on themselves that they've just been in place for a long time. Maybe it's time to reevaluate. Maybe you always set a hardcore policy limit of 5 years. Well, maybe your balance sheet can go to 6 or 7 on an occasional investment. Take a look. Not that it's right for everybody. Again, every case is different, but it's time to maybe reevaluate. What can I do a little different?
It's interesting. We have some great graphs that we put up with snowshoe sales and boat sales, and that things changed. And what happens when things change is that our loan durations change. And I'm seeing a lot right now is that a lot of people's duration is actually shortened. And that we actually need to extend their investment portfolio duration to keep the duration the same from an earnings standpoint. Craig, are you seeing that?
Absolutely. And just to talk about what we've seen over the last month, as well as what we were expecting in 2022, is you really managing that duration is so important. And we're going to have this higher rate environment we are in right now, as well as coming up, to really take advantage of that for the earnings. Our risk position of our balance sheets, in general, can handle it. And it's now we just got to really continue to focus in on earnings. And that's where we're going to take that little bit of extra risk.
And I think dovetailing in what Craig said and Chris said is that having some more risk right now and operating at a higher level, we kind of need to do that to an extent. Almost everyone's at the low level of interest rate risk. So having that increase some is beneficial to our earnings. And consider that, as Chris says, it's not for everyone, but if it's something, you should take a look at it and evaluate.
It's a very good point, Bill. It's interesting with all this focus on earnings we're having here, because it is a passion about earnings. Because one of the things, capital, while it's strong, people are growing capital ratios have come down. So all these deposits have come in, we've seen capital ratios take a hit. Now, it's interesting, a lot of risk-based capital ratios are lower as people's loans are lower as comparison to assets, but overall assets have grown. So total capital ratios are a bit lower due to deposit growth, not losses, which is a very important thing to see there. Craig, given this, what do you see happening? Do you see income going to keep up with asset growth going forward? What's going to happen here?
Sure. It's a good question, and it's a problem that a lot of institutions across the country have been having, is the asset growth versus the growth of their equity has not been necessarily keeping pace. And on average, 30% deposit growth. for institutions. And earnings have not been keeping up with that whatsoever. And that was kind of the bogey point. You want to keep them on pace for each other. At a 30% growth rate on your earnings, or ROE, if you will. We do for the, to make everybody feel better, is we do see, the growth rate to slow up. We're going to see it mediate, and we're going to see a little bit going sideways or flatter with that. So that's where it's really time to try to get our capital to catch up. It's catch-up time, not mustard time, right? Catch-up time. Yeah, so focusing on earnings, and what we're talking about is maybe playing with your duration for the spirit of earnings is to help the capital ratios and bring up. Of course, we've got to manage that risk and understand the modeling, as Bill says. But very important to grow those earnings to help keep regrow our capital base. Some institutions are doing it with issuances and whatnot, which we can talk about, but really the earnings component is crucial to keep up with it.
Yeah, it is. That's the key. And it's funny, when I open up an ALM report today, I basically ignore need and I look right to the earnings component because I'm more concerned about earnings today more than anything. But that being said, we are seeing an interesting point here. We are seeing a lot of clients use subordinated debt or different types of equity right now. Credit unions, banks, everyone combined, we've seen record issuance. And it's actually a great way to help boost the capital up to fit the assets that are here now because of deposit growth. It's one thing I want to share with people is you have to be careful about loan growth. And, we're going to talk a bit about lending now, and a good segue. We've had 5 years worth of deposit growth in 5 quarters. We don't have to lend it all out in 1 year. So we want to work through a process and lend it all out over time. So with that, Bill, speaking of lending, where did clients get success in loan growth in 2021? Where did you see people have success?
The clients we've had success with mortgages, not only originating, but also portfolioing some and holding some on the books to generate earnings and generate yield. That's been a benefit. So we say do this strategically and opportunistically. So we've been having some folks take advantage when rates were higher and hold on to some of those. And also they have been selling them. So generating loan fee income and gain on sale. So that's been a good factor there because you're generating loan origination fees. And if you're selling, you get gain on sale, servicing fees and things like that. Also in the commercial sector, there was some commercial stuff. I want to say rolling over from PPP and commercial loans. There's been an active area. And then also I call them RV or toy loans, boats, motorcycles, ATVs, things like that. So those have really been in demand in 2021.
It's a good, and I think we'll see that continue in 2022. This chart here is loan growth, and it goes back from 2011 to today. And one thing you'll see in the past 5 quarters, it bumped up because of PPP loans, and we're almost all the way back down. My personal opinion, I bet we see here this next quarter that we're going to basically see 0 loan growth for 6 quarters because the government money has come out and so much money is in people's hands they don't need to borrow. So just a quick question here. So for 2022, Bill, you mentioned some of the things you saw in 2021. Do you expect those to continue for 2022 or other things?
I think those will continue to an extent, but I also think there's opportunities in HELOC loans. Because so many people have refinanced their mortgages and those rates are so low that they're not going to be refinancing those. And if they want to take out loans for education or any other things, they may go to that, especially with rates rising. So, the HELOC may be a better opportunity for them than some of the other things.
Cool. Chris, what do you think?
I have to agree with Bill. I've heard this recently from some clients. HELOCs are doing very well. It makes sense. Everybody bought these new houses. They want to fix them up. So it makes a lot of sense.
The East Coast and the West Coast are agreeing. We're going to have a gang war. No, maybe not. No. Craig, anything you want to add there?
Yeah, as we see some of the federal programs slowly taper off, we're going to see people that have gotten used to some of that cash and cash flow that their households have been getting. And we've seen a little bit of the growth actually in the credit card program. It's just starting to pick up. And food for thought for all of us participating here today is dust off your program, your card program, your marketing program for it, because I do believe there's going to be some opportunity in 22, and you want to have it ready to be put in front of your customers in your markets as well.
That's a fair point, Nick. I also love debit card programs for the interchange activity and keeping the core relationship. So it's kind of a non-interest income play on your credit card play there. So,
Right on.
well, one of the things, Craig, I'm intrigued about here, and obviously you and your team see a lot on mortgage investment products, but we've obviously seen a massive refinance of mortgage loan volumes. And here we have just a picture of mortgage rates, just to give us an indication of where things are in the spread with Fannie and Freddie. But where do you see mortgage loan volume in 2022? What do you think is going to happen here?
I think it's going to be very representative of what we've seen in the second half of this year is a big separation of value where new mortgage origination for new home purchases or not refinance, but purchases is going to do well, somewhere in the range of $400 billion a quarter or something with there. But the refi business, we don't expect to be returning to the levels they were at. And it's obviously just economics at interest rates. You know, rates go up, that opportunity, the economics of refining is not going to be there. And so that volume is going to be a lot lower than we've experienced, say, in 2020 and early 2020.
Chris, do you expect to see purchase mortgages stay high in this environment?
It feels like every house has been bought. I don't know what else is out there, but there's always, you know, the next generation coming up to buy the houses that maybe the baby boomers are retiring. So, yeah, I don't think we'll see, you know, the astronomical growth we saw again last year and this year, but it's always there. I think it's always a market to be in.
Yeah, we one of the graphs we have that we've done in some of our profitability presentations talks about how many people have been in their homes for over 20 years. And it's a really big number now, so I do expect we're going to continue to see a decent amount of activity take place in purchases going forward. Not as much probably as last year, but I think it's still, mortgages are going to be a great market to be in. I'd want to be in the mortgage business.
And the builders are building more homes now. Building permits are up, their pipelines are up. So hopefully that'll pick up some activity also.
Yeah, if they can find someone to build the houses, they're building them, right? Yeah. So the permits are there. Well, speaking of finding people, one of the things here in this graph, them two back up again for fun. Greg, we've seen some really great asset growth in 2021, obviously, massive deposit growth, which creates asset growth. Where do you see asset growth in 2022?
So it's hard to say that we can continue on this path. It just wouldn't be healthy for our country and our economy. We do see that the programs are coming to an end, and I think that kind of translates into our asset growth kind of stalling, you know, going sideways, not contracting. Or now the sky is not falling with liquidity or anything of that nature. We think asset growth is going to go sideways. There's going to be some institutions, very, very small, that there's going to be a slight decline in assets. But overall, we're going to have sideways to either slight increase or slight decrease in those programs.
I do think it's obviously we can't. Well, hopefully we don't keep up with the pace. I can't imagine the debt situation. And next year we're going to have a webinar on debt and what government debt really means. Because I'd love to understand that a little bit more as I laugh, because we do debt for a living. So it'll be interesting. So, Chris, you see with a lower refinance volume, you see it modifying your investment recommendations and what we're buying investment-wise in 2022?
Sure. I mean, obviously, as the investments become a larger part of the balance sheet, you want to, as it continues to grow, you're going to take a look at things like mortgage exposure. Can they add mortgages to the portfolio, where maybe before they couldn't because they were mortgage heavy? So watching that balance is always important. Watching concentration ratios. So if it is a tough lending environment, again, keep the cash working. Look at various options for the portfolio to make sure you balance that risk. But again, we continue to see investments are really taking up a larger portion of your balance sheet.
Yeah, they really are. And that's going to be a great segue into the investment section, Chris. So thank you very much. And as you know, we kicked off here with investments. 2020 was obviously a very busy year for investments and a lot of money being put out into portfolios. I think our average portfolio is up about 40% size, so some really big increases in portfolios. What are you seeing happening here in 2022 to tie in with that?
40% might be a peak, but like we said, we're not seeing liquidity walk out the door. We're seeing a lot of loan volume come back or payoffs come back quickly. And so people definitely see liquidity again. If they keep getting the cash to work like we're recommending, the investments will continue to be a strong part of the institution. Make sure the duration works the best it can for you. If you could take on more risk, we recommend that. And again, broaden your horizons. What other sectors can we add? What different type of investments can we add to the mix?
And speaking of that, I'll ask Craig this, and Chris will ask you the same question. Where do you see value in the bond market today? What are you recommending people to buy today?
Good question. Is one of the things that Chris mentioned when what we've been doing, and it's this environment has been absolutely fantastic for diversification on an investment portfolio, as it's become a more prevalent asset class on balance sheets. It's given the opportunity to expand into asset classes that didn't necessarily have to be in when their investment portfolios were smaller as a percentage of overall assets. So where we've been seeing value and as a very well-structured CMOs that are wrapped by agencies or GSEs, mortgage pools, and still really playing in the municipal market. It's been a wonderful market. We've seen a lot of improving credits with the economy we've been experiencing in. And then in the corporate sector, there's not enough excess yields going on, really high yield stuff. So we've been not necessarily adding a lot into that sector. It's really been in the municipal market, CMOs and pass-throughs.
Chris, want to add into that?
I think that's a great example of why it's important to go back to the drawing board, go back to your policy. Do you allow for those sectors? We see a lot of people that maybe have thought about corporates, but then I don't know, or munis. Now's a great time to really reevaluate. We'd love to help out if we can.
It is diversification is key, and not being stuck in any one sector has got to be one of the key components there. But with that, one of the things that's interesting in investing, we've asked this question a lot, even more this last year and a half. How much cash should we have in our balance sheet? And the answer is 7.3%. There you
Exactly.
go. Simple and easy. We tell them, listen, it's somewhere between 4 and 8, 4 and 10% is the range, depending on the structure of your balance sheet. 10's pretty high, 4 is pretty tight. And that's something that's a very tough one to answer. It's very specific to your balance sheet. But in general, somewhere around 6, 7% is probably a good spot for most people in the generic term. I know we all want to get loans, but it's going to take a while. You guys, is there anything you want to add to the conversation about deploying excess funds? And we've talked a bit about loans and investments. Anything else you have to add there?
One of the important things about deploying cash is to have a plan, right? Chris mentioned about this is a great opportunity to expand policies. Not only asset classes, but looking at the duration, looking at maximum maturities, looking at credit, full revamp of investment policies to accommodate, us in deploying cash. And so, but once that's done, then having a very deliberate purchase plan, establishing it, predicting it, and then implementing it regardless of what happens to interest rates. Extremely important. And that'll help whittle down that excess liquidity that we have. And some might, ones that say, hey, yeah, I usually have 15% of cash. I don't want to go down to 7. Well, we do highly recommend it for earnings standpoint. And the important thing to do in complementing this is to make sure you have your good liquidity and contingency plans ready. Have lines ready in case there's something that happens in the market. Otherwise, you got huge opportunity costs. So we really say, create the strategy, stick to it, invest your cash down to the prudent level so we can maximize earnings.
And the one thing I would say also about that is that, a lot of our clients are in CDs that are maturing, as Chris mentioned earlier. So the CD rates that you come into are much lower than some of these other asset classes. So again, that goes back to Chris's scenario. Look at your policies, look at other asset classes that you could go into, because your CDs, if you roll them back into those, you're going to be much lower rates than these other investments.
Yeah, it's a very good point, Bill. You probably don't want to be buying CDs today. It's a short answer there. So, well, thank you guys. With that, I want to flip over to non-interest income for a second. Really important thing to talk about is I think it's going to be a big component of earnings for the next few years. Craig, what types of non-interest income businesses have you been seeing clients acquire?
So development and acquisition has been taking place across a few different assets or business lines. Mortgage has been really a big key. Bill mentioned earlier about his expectations on mortgage volumes. We continue to expect that to be an excellent form of revenue going forward. A lot of institutions still don't have a material mortgage department or a mortgage team. It's really important to be establishing that. We're in a great economy. We don't expect housing prices to decline. We've got more houses coming online as we get workers back, and it's going to be a great source of revenue for institutions. Another thing is insurance. And as I talk to clients over the last 12 months, one of the common questions I ask is, what's your penetration rate on lending insurance? And it's really surprising. It's been as low as 5%, and it's been high as 40%. And, it's a real significant, impactful source of revenue for insurance. And there's a lot of training and product knowledge that needs to go along hand in hand with that. Some other things is then the story of the SBA market, still very relevant for companies. The fees that you can generate or sell on the SBA loans are still really good at selling the guaranteed portion of these SBAs. Still a wonderful market, and still a lot of great revenues coming in from there. And what's really important to think about this is a lot of our clients across the country have really benefited from the fees from the PPP program. Most of the first round have been all paid off. Second rounds are very well into it, and there's not going to be a ton left of fees to amortize or to recapture, or recognize, I guess is the right word, as these pay off. So these types of programs are extremely important to make sure we replace that income that we've become accustomed to.
Another thing I would say is that some clients had reduced fees during the pandemic to help out. Some, to go back just to the previous fees, is helping out to an extent because they had lowered them 20–30% to help folks out with the pandemic. Maybe when the pandemic is, I don't want to say over, at least getting close to over, you can go back to some of your normal fees. I see some clients picking up income from that also.
Yep, that's nice. Some other sources of non-interest income, title, something we can talk about. We're seeing a lot of clients get involved in title, and then broker in the lobby. It's actually an area, as the stock market as well, you have more assets under management. So it's actually been an interesting area too. So it's really important. We used to tell clients for a long time to have at least one good source of non-interest income to go along with your net interest margin. Today, I think it's two. So I really encourage you to be good at least two things on here. And I think one of them should be mortgages. And I think there's going to be a great opportunity in the mortgage market, as Craig mentioned, all of us have mentioned now, in the next couple of years. So really, really important. So one of the things that's going to be really interesting to me is industry income. And what I'd like to know, and I'd like everyone to weigh in. I'll start with Bill, then Craig and Chris. Just give me a quick answer. Do you think the industry income is going to be good, poor, middle of the road next year? What is your recommendation?
I think it's going to be middle of the road, similar to what it was this year. Less PPP fees coming in, less refinance activity. But I think, with the assets you put in the work, you'll have that work in front of you versus against you.
For some of the regular traditional products, it's going to be lower. So it needs to be offset with some other products or sources of revenue.
Chris?
Yeah, with like you said, the PPP income, the higher coupons in the portfolios coming off, it's going to be a little bit tougher.
Yeah, it's going to be different. So, all right. So a little bit of a free for all. A little bit of parting comments from the three of you. Then I'm going to give some insights and answer a few questions here. Bill, what do you see in 2022?
2022, I think the second, the first half is going to be like the second half of this year. Rates will start rising. I think as Craig's mentioned, on the long end of the curve, the front end is not going to be moving. So it may slow down prepayment speeds and slow down origination, some on the refi side of the mortgage business. But I think the purchase market still should be pretty good.
Great.
Well, I'm going to take a little bit of an economic answer to this question.
So you're not going to answer it.
I see that the job market's going to change a little bit as we go through 2022, which is going to continue to improve a little bit. I think that participation rate is going to slowly go up, and it's going to ease up on some of the variables right now, which is causing people concerns. So which means I think it's going to be a decent year with a road to recovery. Still positive, but a contracting, not as high GDP, which is going to offer us opportunity as lending institutions to take advantage of as long as we're positioned with the right products to deliver to our customers.
So we're going to take a sidebar here for a second because you did bring up the participation rate. We do have a question. Client was wondering, why is the participation rate so low? And can you give your insights why the labor force participation rate is closer to 61% today versus 63 or 4?
Sure, yeah. And just on the surface, you look at the number that's only a few percentage points off. With our population, that's a lot of people not participating in the job market. And I think this whole pandemic has driven a different state of mind for people of, you can look at the dual income families where one said, this is too much to deal with. I'm going to stay home. I'm going to take care of the household. That's my job, the children, the property, whatever it may be. People are doing that and trying to live. Now, we also see that there was the government assistance programs that really put a lot of money into the system and made it easier for people to make that decision, quite frankly. And then lastly is the wage inflation that we've seen, and this is a chicken and egg question, which comes first, but with that little bit of wage inflation we've seen, that also helps that decision take place. And there are some people that are just going off and not doing their thing. They might be working not on regular payrolls, but working under the table, if you will, is the old term. And I think that's still a term nowadays, is what that.
All right, Chris, quickly, what would you like to add to that?
One of the things we haven't talked too much about, next year is a peak for people turning 65 in this country. So there's a lot of baby boomers getting out of the job market, but yet we don't have the skills to replace them in some situations. So that's leaving, I think, a lot of these jobs open as well. So demographics definitely has a role in this as well.
Yeah, you can't leave demographics out of any conversation like this. That's a really good point, Chris. I appreciate that. Well, a few closing comments here as we wrap up the webinar, and I really appreciate all the questions. I want to thank Kaylee and Ian for handing me off the questions and letting me answer them on the fly. So with that, thank you for our technical help. We do want to apologize, a little bit of technical difficulties, our first time with this format, so thank you for sticking along with us. A couple points I want to close out with is that we do feel that interest rates are going to be low. The Fed has to taper before they cut rates. So I know there's a lot of people calling for higher interest rates. You need to take that into a realistic approach and understand it's easy to get on TV and jump up and down and yell and say interest rates are going up. Let's take a step back and realize that. I do think it's also important with investments that we think about the duration. We don't want to make a bet and have things sitting in cash. That's not going to give you the good earnings you need. Earnings right now are more important than I've ever seen in our industry to get capital to grow back up as a percentage to our asset growth. We have 5 years of earnings we need right now. If we're going to set money on the side and sit at 5-10 basis points, it's not going to get us to be able to keep up with our asset growth, and we're going to find ourselves in more and more trouble as time goes by. Deposits, we definitely are going to see a slowing of deposit growth. We don't see nearly as many government programs on the horizon. We see the big one they're talking about stalling. And so we do think that we're going to see stable deposits and maybe people spending a little bit of money. Probably not as much as they want with some of the demand-based problems we're seeing and transportation problems. But as we think about deposits, you always want to grow checking accounts, money market accounts. We've seen a lot of clients stop offering CDs. That might not be right for you, but there's something to think about. Let's really focus on getting transaction accounts as we go forward because of the cheap cost of funds. In the loan area, we do think it's going to be great opportunities for lending. I still think mortgage, it might be a bit of a contrarian here. As Chris brought up, home equity lines of credit, expect those are going to go quite well. We're not going to see people pay off their 2.5% or 3% mortgage to redo a bathroom or a kitchen. They're going to go borrow money instead of paying that mortgage off. So we think that's going to be big. And here we are in Detroit. We haven't even talked about the chip problems or some of the problems and lack of production. Used car prices are going up. So we're going to see a decent lending in used cars for the next few years. And in the end, non-interest income. Last point we hit today, really, really important. We have to have non-interest income because we're going to see these tight margins persist for quite some time. The large banks have a ton of cash. The JP Morgan's world have a ton of cash, and they're going to do their best to put that in loans, and it's going to keep loan rates low for an extended period of time. SBA is another great area Craig mentioned earlier. So with that, I want to thank panelists here. I want to thank you, Bill, for making the trek in from California, spend some time with us. Craig, thank you for your insight.
Welcome.
Chris, thank you for representing the East Coast and coming in, spending some time with us. And I want to thank everyone here for our technical help. With that, our next webinar is going to be November 10th. It is going to be on investing. And investing, it's going to talk a lot about duration and products and expanding your horizon in investment products. So with that, thank you all very much. Hope you have a wonderful day.